Hello, can you hear me?
Oh, at last, Ryan. Good
Yeah,
morning.
yeah. Right.
Deary me.
Sorry about that. It's connection issues in Dalston, unfortunately, third world country. Anyway, as I was saying to myself, welcome to today's morning blast. It is finally Friday. What a year this week has been. It's April the 4th. This is the morning blast. Myself, Mr. Michael Brown. Before we get underway, I'll get the legals out of the way. So, as usual, nothing discussed on this basis session constitutes trading or investment advice or infers any kind of endorsement by PIQ or indeed the hosts, which is finally myself, Mr. Ryan Paisley, and of course, Mr. Michael Brown. Oh, hang on. Whilst I was offline, did you call me a dwarf?
Yes, I did. Yes.
Oh,
Your
nice
connection
rhyme.
wasn't that bad then.
No, well, Zach's dobbed you in grass.
Oh, dear. Bloody Zach, eh?
Right, crack on. What's going on?
Indeed, yes, let's get on with things. Good morning, everybody. Happy Friday. A very happy jobs day, of course, although potentially the most inconsequential non-farm payrolls number for some time coming up a little bit later on today. Of course, yesterday, unless you were living on Mars, you will surely be aware that it was a very, very risk-averse Thursday as fallout from Trump's Liberation Day announcements on Wednesday evening continued, and market participants continued to seek shelter from what was a storm of tariff headlines, which were all clearly at the much punchier end of market expectations. And as we alluded to on the morning blast yesterday, it's very much a case of market participants focusing on the downside growth implications of those tariffs as opposed to the potential upside inflation risks that they may bring. In terms of some of those market moves yesterday, we saw the S&P 500 close as near as makes no difference 5% lower, while the Nasdaq 100 shed 5.4%, with both of those benchmark indices notching their worst days since 2020, and declines also being seen in the European session and also through Asian trade overnight. In the Treasury complex, we saw gains across the curve, with the two-year yield falling a whopping 15 basis points, trading down to
Oof.
3.7%, and the 10-year yield falling about 9 basis points, trading down to 4.04% at the close yesterday. And we've seen those moves extend during the Asian session, with the two-year down another 5 basis points this morning, the 10-year down 8 basis points this morning, trading at 3.95%, below 4% for the first time since the back end of last year. Meanwhile, in the foreign exchange space, we saw the dollar soften against all G10 peers, and that softness is by and large continuing this morning, although the Antipodean currencies are perhaps bucking that trend somewhat. Nevertheless, the dollar index falling 1.5% yesterday, trading to lows around 101.25, while cable rallied about 0.6%, briefly trading north of the 132 handle. Dollar yen trading all the way down to 145.5 during the Asian session. That's down 5.5 big figures from when Trump started speaking. And last but by no means least, the mighty euro
Oh,
roaring
piss
once
off.
more with the
Go
common
fuck
currency
yourself.
rallying all the way up to 111.5 yesterday, finally meaning that the most long lasting and bet in the world has been won by yours truly. Ryan, I will share my diary with you later so we can get that lunch booked in,
You
which I'm
absolute piece
sure
of
you're
shit.
very, very pleased about.
Oh, well, you're a twat.
Oh, I wasn't going to let that slide, was I? Let's be honest.
No, obviously
Uh,
not. Obviously not.
in terms
Moving
of
on.
yeah, moving swiftly on for Ryan, for the sake of Ryan's mental health, we did in an interesting move yesterday. We actually saw gold trading lower by around about 1% on the day, and we see the yellow metal trading another 0.6% softer this morning. I need to give a big shout out to our mutual friend Henners at News Squawk. The intern has come good to provide this little
Oh,
nugget of
wow.
information. The reason, or one of the reasons, why gold did not attract the haven demand that you might have expected yesterday is because the White House actually confirmed that imports of gold are going to be excluded from all of the reciprocal tariffs that the US has been
And
throwing
silver,
around.
right?
And silver, correct. And this is important because one of the reasons that have been propelling gold higher have been people effectively trying to front run these tariffs,
Yes.
saying, if we want gold, we may as well import it now before we have to pay,
Yeah.
40% more. Now that we've
And
had
and it's sorry, and it's the reason why the New York gold was trading at a premium to London gold. It also
yes,
impacted the GDP data. Like, so, it's very easy for a lot of people to kind of just kind of ignore the story,
Mm.
but this massive front running of the gold trade has had huge impacts, not just on economic data, but in terms of like the price capacity as well. It's been a bit of a crazy situation going on.
Yeah, absolutely. And of course, now we've had confirmation from the White House that gold and other precious metals are excluded from those tariffs. You actually start to see some of that risk premium getting unwound, which is
Yes,
effectively the move that's taken place over the last couple of days. And if you look at chart spot gold, you can quite easily pinpoint where it was
and
and when it was confirmed that they were excluded.
not naming any names, but a certain purveyor of spam, obviously that's come back onto the internet. Who? What was that giggle?
Geezer doesn't even like spam. This is
Doesn't even like spam, but was hoarding spam during COVID. He's got back onto Twitter and has been very bullish gold and silver because he thought this the tariffs would be massively bullish. So he's had a bit of a stinker. So back into his little nuclear bunker full of spam he goes.
indeed, yes, he can disappear again, thankfully. But yes, that's the story with gold. Thank you to Henners for that. He can maybe become senior intern if he keeps producing information
Wow.
of that ilk. The last market move, just to cover off before we get to some fundamental catalysts, and this actually leads into one quite nicely, is the huge downside that we've seen in the crude complex over the last couple of days. WTI trading 7% lower yesterday to $66.75 a barrel, and we're down another 2% this morning. So quite a slick fall in both WTI and Brent. One of the reasons for this is obviously the big growth scare that tariffs have caused. And with perfect timing yesterday, we had news from OPEC, or OPEC Plus, I should say, who have agreed to make a larger than expected supply increase in May. They are going to increase output by 411,000 barrels per day, which is a very precise amount, from the start of next month, which is equivalent to 3 times the planned monthly output increases. So a bit of a perfect storm facing crude at the moment, where you've got increasing worries about the jittery state of the global economy, coupled with more supply coming onto the market. Demand down, supply up, price is only going to go in one direction. In terms of other fundamental catalysts from yesterday, of course, focus remained on the trade situation. We did hear from a few members of the Trump administration. Of course, Commerce Secretary Howard Lutnick was on television, as he always is. He was really doubling down on what Trump had been saying. When you cut through all his usual nonsense, he confirmed basically that Trump is not going to back down in terms of the tariffs that have been imposed. The other interesting thing that Lutnick did say is that tariffs on some Chinese imports will be as high as 79%. And this is because obviously the US have imposed a 34% reciprocal tariff. You've then got the 20% tariff around the issue of fentanyl. But something everyone's forgotten is what's called Section 301 tariffs,
Oh
which,
yes.
well, catchy, exactly. But these were the ones that Trump put in place in his first term, and which Biden then kept in place, and which are still in place, and which are added on top of what Trump has announced over the last 3 months or so. So China is getting an absolute beating in terms
Tariffs
of
all the
the.
way down.
Yeah, indeed. We also have from the Vice President, JD Vance, yesterday saying that the Trump administration are not going to fix things overnight, which is probably the understatement of the week. And we also heard from the president himself as he was boarding a helicopter to bugger off for a golf tournament in Miami. He said that he would negotiate tariffs if offered something phenomenal. God only knows what sort of phenomenal offer he may want to see. He confirmed that the administration are still looking at tariffs on both pharmaceutical products and on chips, while also saying, and I can't believe he came out with this, that the market response to tariffs was expected. So, we know Trump went short before his press conference, I think,
Well,
is
to be
probably
honest,
the
this
take
this
from
does
that.
play this does play into what we've been saying over the last week or so, where he's very obviously doesn't care about the stock market at the moment,
Mm.
and potentially as it get like front run all the bad news and negativity into the stocks, we then get a rally when all the dust settles and kind of now we've set um, this very negative line on tariffs. So then kind of you would expect the headlines coming forward over the next few weeks and whatever will be like, deals being made and stuff, which every little one's going to be a little bit more bullish, a little bit more bullish, and that leads, over the next year or so, leads into the midterms. That's, we mentioned that before. So potentially, but then are we giving them far too much credit? I don't know.
Yeah, I think we might be, sadly, on that one, but only
Yeah.
time will tell. We did, of course, have a number of global responses to the tariffs that have been imposed. I really don't have time to go through all of them because basically every country that's been hit by a tariff has said something about it, and that is every country in the world, and there's
Even the
190
penguins.
odd of them. Exactly. The main sort of takeaways are really from Europe. Germany, France, and Spain are all taking quite a hawkish stance in terms of the European response to tariffs. Both Germany and France, according to Bloomberg, citing sources, are pushing for a focus on big tech companies and US services firms
Yeah.
in order to strengthen the European Union's negotiating position. The Spanish Prime Minister, he asked the European Commission to, and I quote here, reinforce trade links with the rest of the world, also saying that they need a package of counter tariffs. But interestingly, in addition to all of that, responding with, and I think this was pretty unexpected, a 14.1 billion euro stimulus package to protect and insulate the Spanish economy. So it'd be interesting to see, given that Germany have now started to turn on the fiscal spending taps, whether other European nations decide to go down that path. We'll leave the issue of trade there for a moment. I'm sure, Ryan, you might have more on that in a second, but there were a few other bits and bobs going on yesterday that I did just want to mention. In terms of economic data, we did have, of course, the latest ISM services PMI, which missed expectations, falling to 50.8 in March, down from a prior 53.5. We also saw the employment sub-index fall into contractionary territory at 46.2, which of course means that both the ISM manufacturing and services employment gauges are now below that key 50 bellwether, or break even, I should say, ahead of the March non-farm payrolls number, which we get at lunchtime today. Sticking with the US labour market, we also had the monthly Challenger Gray and Christmas hiring and layoffs data yesterday. Their data reported that job cuts in March hit their highest level since May of 2020 at a very precise 275,240, with government job cuts making up 217,000 of those
Oof.
cuts. I would, however, I mean, clearly that data is not very, very good. But I would caveat that by saying that the way Challenger Gray calculate this data is to compile the announcements of layoffs as opposed to the layoffs that actually happen. So they're not looking at how many people fall off payrolls or anything like that. They're basically saying a company has announced 10,000 layoffs. We'll add that to our tally. The other thing I would say about that Challenger Gray data is yes, it counts layoffs, but it doesn't count hiring. So of those
Yeah.
people, you could have 217,000 who'd lost their jobs, 216,000 have got another job, but it makes for a bit of a scaremongery headline. So do just take
Yes.
that with a little bit of a pinch of salt. In terms of other bits and bobs from yesterday, a couple of other things just to mention very briefly. We did have minutes from the March ECB meeting. Of course, very stale at the best of times, even more stale than usual, given how dramatically the economic outlook has shifted over the last, 24 hours effectively. But nevertheless, these minutes did emphasize that both a rate cut and a pause in the cutting cycle are on the table for the April meeting, which is very much in keeping with sources reports that have come out of the ECB of late. And actually, another point that I'd just make on not only ECB minutes, but Fed minutes as well. Yes, they are a record of the meeting that happened 3 or 4 weeks ago, but they're also a signaling mechanism. And a
Yes.
central bank will deliberately make choices as to what they do and don't include in those minutes based on what they want to signal at the time of their release. It's not a transcript, it's not a recording of what happened. If anyone remembers Yes Minister, the BBC programme, the minutes are manipulated to give the impression you want to give. And that is exactly what central banks are doing with their
You really
releases.
are. You really are a 60-year-old trapped in a 27-year-old body, aren't
I do think I am at this point. Last
you?
but by no means least, news out of China yesterday in terms of credit rating agencies, who are, of course, always
Oh
ahead of
yeah.
the curve. Fitch, they downgraded China to A with a stable outlook, and China reacted to this as well as you would expect, with a spokesperson for the Chinese government saying that the ratings downgrade is biased and does not at all fully reflect the situation within the country. Seems like they're a bit rattled by that one, but nonetheless, certainly something to keep on the radar. And actually, speaking of credit ratings, I'm not sure if they really matter these days, but there is growing speculation or maybe even expectation that at some point this year we will see further ratings downgrades in the United States. So just a sort of longer run theme to keep on the radar. And for the moment, that is all from me.
Wonderful, wonderful. Thank you very much, Mr. Michael Brown. So, as usual, some choice headlines from the overnight news roundup, which is compiled by the amazing Zachary on the slopes currently.
Well, he
But he's
was
still putting
amazing
an
until
effort
he
in.
started grassing me up.
Well, there is that, my little spy inside the works. But kicking off with tariffs, unfortunately, it's always going to be kicking off with tariffs for the foreseeable. The president hinted he may lower tariffs for nations that offer major concessions, specifically calling out China if ByteDance sells TikTok's US operations. However, internal White House talking points direct surrogates to frame tariffs as a national emergency response rather than a negotiation tool. Senior officials weigh in. Trade advisor Navarro insists tariffs are here to stay, quote, and are not a bargaining chip. The NEC director Hassett concedes the EU is unlikely to budge. Vice President Vance noted it. A quote, it could be worse in markets, implying some relief in equity prices. I think he was another one calling for circuit breakers. In terms of political rifts, several top Republicans openly oppose Trump's move, threatening to split the party. The EU's initial plan to retaliate is delayed by disagreements among member states over which products to target. I,
Classic
I think we,
EU.
yeah, well, exactly that. I thought we saw there was someone, it actually might have been someone out of Germany was going on about, oh, a unified EU. And I was like, do me a favour. There
I
is no
think
way this is going to
I
go
was
on.
just bloody annoying, but I think it might have actually been Zach who said there's no way 27 countries in the EU are going to agree on it.
No, absolutely. They couldn't have, they genuinely can't agree on what to have for breakfast, let's be honest. Um, in terms of global reaction, EU diplomats says Commerce Secretary Lutnick has, quote, little influence. I think we all know that at this point. The real shot caller is Navarro. The French finance minister Lombard wants a proportional reaction that avoids harming EU consumers. Good luck coming up with that one. Canada, they've imposed a 25% tariff on US autos worth 35.6 billion. China fears a global glut of cheap Chinese products flooding other markets due to US tariffs, as well as a domestic push to replace lost US demand. In South Korea, Japan, Vietnam, and Thailand, obviously these are countries that have hit pretty hard. And as me and Michael Brown mentioned yesterday, the companies that have moved from China to Vietnam have had an absolute stinker. All of those are taking emergency measures from providing industry support to actively seeking negotiations, obviously worried about the direct blow to exports. In terms of macroeconomic implications, inflation in the Fed, analysts see potential short term inflation spikes possibly hitting 5% if tariffs stick. JP Morgan, Piper Sandler, and UBS all raised recession odds. The Fed's tariff concerns might hamper any stimulative rate cuts, with some banks pushing out their cuts forecasts entirely. We did comment yesterday that Morgan Stanley have pushed their cuts out to 2026, if I recall correctly. Correct me
Yeah,
if
you're
I'm wrong there,
spot on.
Mister.
I think this is
Yeah.
actually a really interesting dynamic at this point because you've got
Ooh.
a really big split among analysts on the sell side, and by
Yeah.
extension, you would imagine market participants as well, where you've got a chunk going, and certainly the way that markets have repriced this morning with now four Fed cuts discounted by the end of the year, going, the Fed are going to have to loosen up much more quickly to support economic growth. And then on the other side of things, I think I'd probably fall into this latter camp at the moment. You've got a group of people saying, well, actually, yeah, maybe they'd want to, but if inflation's going to 4 or 5, then they're not going to be able. to cut by
No,
that amount, or as soon or as quickly as you would perhaps want them to. So yeah, I think that's an interesting dynamic that's starting to pan out actually.
absolutely. And I think when you get, and obviously when you get divergent views on the street such as this, it does mean that like markets, especially the short end and stuff, can be more liable to volatility because
Mm.
not everyone's going to be positioned the same way, and at some point someone's going to admit they're wrong. So we could see some quite interesting dynamics play out
Yeah,
in the short end of the
one
curve.
one thing that is quite well worth watching, given the sort of dispersion and divergence between these views. I'll try and dig out a link for it, but on the Atlanta Fed website, they've actually got a probability tracker. Not so the CME obviously have a probability tracker for cut, hike, percentage,
Yeah,
etc.
Fed Watch.
The Atlanta Fed have actually taken SOFR options and split out a probability
Oh,
distribution from that. It's a really, really useful tool, especially if you
yeah,
don't
dig
have
that
something
one
like
out.
a Bloomberg.
Yeah, definitely dig that one out for
I'll
us,
have a
please.
gander now.
Thank you very much. In terms of global ties, South Korea, the US, and Japan agreed to boost energy cooperation via US LNG. Europe braces for a wave of Chinese goods priced cheaper to avoid US levies. I think this is going to be
Oh,
pretty much a global theme with Chinese goods flooding the market. Now they're not going straight to the US. Consumer rush. Americans are rushing to buy TVs, honestly, soy sauce, Lululemon apparel, etc., before the tariff driven price hikes hit store shelves. In terms of geopolitics, US Russia, high level talks on resuming direct flights after the Ukraine conflict. Trump also warns that new tariffs on US weapons supply chains could hamper the Pentagon. Regarding Iran, Trump believes that Tehran wants a direct nuclear negotiation. On EU and NATO, this morning we heard that Europe's top defence officials gathered to counter what they see as a because I tried pronouncing this word yesterday. Yes, and revanchist Russia. Hungary and Ukraine, tensions remain as Brussels looks for innovative ways to circumvent Hungarian vetoes, especially on Ukrainian support. And finally, for me, some corporate and market news. Meta, in an FTC showdown, they face off soon in federal court, testing the new Trump appointed antitrust regulator's willingness to crack down on big tech. Nvidia, fresh chatter suggests a potential chip launch delays for Blackwell. That's the GB300 for Tom Talks Cars.
oh,
DigiTimes says a
surely he won't be
Q3.
awake this early on a Friday.
Oh no, he is. He is. I can see him
Oh, is it?
listening.
Oh, good
Uh,
morning, Thomas.
yeah, there you go. DigiTimes says a Q3 date is uncertain, possibly in spring, slip into spring 2026. Apple, Musk, and satellites in general. Tensions over how to eliminate dead zones via satellites is in play. Obviously, we saw, was it Amazon or yeah, it was Amazon stick up their Kuiper satellites yesterday, I believe.
Mm.
So again, a contender to the Starlink, which obviously Musk run. Um, Elliott targets Phillips 600. Activist investor calls for a midstream spin-off. Sticking with oil majors, BP and Shell. BP's chairman to step down next year, while Shell sells a stake in the Colonial Enterprises. And finally, US car dealerships see a short-lived spike in sales as buyers aim to beat the new auto tariffs. I think we knew that was coming. Just one thing to like an interesting tidbit is obviously anyone that's in the US that has a fairly new European car, they're going to be looking at a bit of a windfall now because obviously there's
Mm.
going to be a mad rush to try and pick these up. And it's worth keeping an eye on used car prices because anyone that remembers way back when, during COVID, the used car market had an absolute tear, and that was in having quite a weighty impact onto the CPI data due to the weightings makeup. So definitely one to keep an eye on.
Yes, absolutely. You're absolutely spot on there. The
Oh,
thing.
stop it.
I know it's bloody annoying. The thing to watch there is the Mannheim used vehicle prices. I think they
Yes.
publish that once a fortnight, and as you say, it does have a bit of a rather a too high weighting in terms of inflation metrics.
Yeah, absolutely. Absolutely. Back to you in the studio.
Cool, good stuff. Thank you, Ryan. In terms of today, then, it is, of course, the first Friday of the month, which means for a brief moment, probably lasting about 30 seconds or so, we'll be able to set some of the tariff nonsense aside and focus on the latest US labour market report. Headline non farm payrolls are expected to have risen by 140,000 in the month of March, pretty much unchanged, albeit a modest slowdown from the 151,000 pace that we saw in the month of February, though, as always, it is worth paying close attention to the 2 month net revision. The range of expectations for the payrolls print is, as always, a relatively wide one, between 80,000 at the low and 200,000 at the high. In terms of leading indicators for the payrolls number, both initial jobless claims and continuing jobless claims were as near as makes no difference unchanged between the February and the March payrolls survey weeks. Meanwhile, as I mentioned earlier on, both the ISM manufacturing and services employment indices were in contractionary territory in the month of March, with the manufacturing index actually printing its second lowest level since 2020. In terms of other anecdotal factors to keep an eye on that may skew the balance of risks around the payrolls number, there is, of course, a heightened degree of economic uncertainty in the United States at the moment, though do bear in mind that the payrolls week, as always, references labour market conditions in the week containing the 12th of the month, so will not count for any of the recent announcements that Trump has made. Nevertheless, that uncertainty may have resulted in businesses changing or halting their hiring plans, while of course there are also risks around the shrinking size of the federal government as the Department of Government Efficiency continues to lay off federal workers. On the other side of that, there may also be a return of some striking workers. There were some supermarket strikes in February that could add between 10 and 15,000 to the jobs number. And of course, there is the continued return of workers in California from the wildfires that we saw in January. There are still people coming back into employment in the aftermath of that. In terms of other parts of the labour market report, sticking with the establishment survey, average hourly earnings are expected to have risen by 0.3% on a month-on-month basis, unchanged from the pace seen in the month of February, while that would keep the year-on-year pace unchanged as well at 4% exactly. Meanwhile, in terms of the household survey, unemployment, that is seen holding steady at 4.1%, while participation is also seen holding steady at 62.4%. The one thing just to bear in mind on unemployment, oh dear, there seems to be a terrible echo coming through here. I don't know whether anyone else can hear that.
It's fine by me.
Oh, maybe that's just on my side. One thing to note on unemployment is that, and this is very nerdy, is that the unrounded figure in February was actually 4.1395%. The reason I mention that is because a rise that would take the rounded figure to 4.2% is not actually a huge stretch at this moment in time. So you wouldn't need a huge rise in unemployment to tip that rounding back over into 4.2%. So do just bear that in mind a little bit later on. In terms of the payrolls report at large, just to frame market pricing around it, we see around about a 1 in 3 chance of a 25 basis point cut at the May Fed meeting, with a 25 bip cut fully priced for June and around 100 basis points worth of easing priced by the back end of the year. Of course, I think focus for market participants is firmly on other matters at this moment in time, namely the continued fallout from Trump's Liberation Day tariff announcements, and it is kind of tough to imagine what is ultimately a pretty stale labour market report being a game changer in terms of either financial markets or the FOMC's monetary policy outlook. The one thing I would say, though, is that I think risks around the payrolls number are asymmetric for financial markets this afternoon. What I mean by that is if we were to get a better than expected slate of jobs data, that on its own would not be enough to soothe these ongoing worries over the state of the US economy and potential recession risks. On the other hand, if we were to get a soft payrolls print, then that would likely add further fuel to the fire and crystallize those growth risks that market participants are worrying about, in turn resulting in another bout of risk aversion and probably another bout of dollar downside as well. On the whole, though, I think market participants are going to try and move past the payrolls report as quickly as they possibly can, with focus remaining firmly elsewhere. In terms of other bits and bobs on the docket today, we do also have employment figures out of Canada, which no one cares about at the best of times. Certainly no one cares about them right now. But do just bear in mind that it could potentially skew polling as we move towards the election at the end of this month and give Carney a little bit of campaign rhetoric. In terms of other things to focus on today, of course, continued responses to the tariffs that were announced yesterday, as well as, of course, any rhetoric that we may get from the Trump administration. And then we have the not insignificant matter of a speech from Fed Chair Jay Powell at 4:25 this afternoon, London time, where, of course, he will probably try and stick to the script as much as he possibly can, but he's also undoubtedly going to be asked about the Fed's potential policy response to what Trump has announced in terms of
I
tariffs. A couple
fancy,
of other things just to bear
so
in. Oh,
I
go on.
fancy he's going to use the word uncertainty quite a fair bit.
Oh, absolutely. He is not going to commit to
No.
anything whatsoever in those remarks later on. A couple of other things just to bear in mind, of course, be aware that there is the potential for de-risking as we move into the
Yeah.
weekend, given how ridiculously uncertain the market is at the moment in the macro environment. There is a chunky potential for gapping risk on Monday morning, and I think participants will seek to hedge that. And last but by no means least, in a really cruel twist of fate, as I wrap up my remarks for the week, euro dollar is now trading at 109.79.
I'll poke it. You absolute bastard.
And on that note, that is all from me this morning, and for what feels like has been the longest week
Yeah.
ever.
Well, thank you very much, Mr. Michael Brown. As always, listeners, thank you so much for tuning in. We really do appreciate you. Also, final shout out for this evening's non-farm pints. So if anyone fancies a beer later on, myself and Mr. Michael Brown will be in Gibney's in Old Street from about 4:30, 5 o'clock onwards to come down, have a beer, and watch Michael Brown put his card behind the bar. Potentially
Oh,
sources.
yeah.
But anyway, guys, thank you so much. Have a great week. Have a great weekend. And we'll see you on Monday.
Indeed. Bye for now.